Welcome to the Fear and Greed Business Interview. I'm Adam Lang. Headline inflation fell to 2.7% in August, and that's down from 3.5% the previous month. It's the first time inflation has been within the Reserve Bank's 2 to 3% target band in almost 3 years. However, with much of that drop due to electricity bill rebates, the focus remains on underlying inflation, the Reserve Bank's preferred measure, which is not telling a great story. Today, I'm joined by our favourite resident economist, Stephen Koukoulas, better known as the Kouk. You can find him at thekouk.com and follow him on X using the handle @thekouk. Stephen, delighted you've joined us. Welcome back to Fear and Greed.
Thanks, Adam, and so much to talk about with that one number, the inflation number. There's so much within it.
I agree. Now, Stephen, I mentioned the headline number at 2.7%. What's your perspective on that and the underlying inflation figure of 3.4%?
At face value, the headline figure, it's nice to have inflation back within the 2 to 3 band. I don't think anyone would disagree with that. And from a cost of living perspective, that is the relevant issue because we, the consumer, are saving on our electricity subsidies. They are coming through on our electricity bills and some of the other, the 50 cents that the state government in Queensland is charging for public transport, that had a small effect too. So there were, a myriad of issues that forced that headline figure down to 2.7%. And as I said, that's good news. And just as an aside, before we dig into the underlying measures, the RBA mandate, the RBA conduct of monetary policy, I think it's called, that Michelle Bullock signed with the Treasurer Jim Chalmers back in December last year, is about inflation, not trimmed mean, not underlying. It's about inflation. So that just complicates what we're about to say, no doubt, on the underlying and trimmed mean inflation measures.
Yeah, look, I totally agree. There's a lot of measures within that 2.7 number. The underlying figure, despite the mandate for the RBA, how are you seeing that?
Yeah, look, luckily we saw RBA Governor on Tuesday afternoon, Michelle Bullock, give her press conference after the rates on hold decision that we've covered a lot over the last few days. And she said that she was pleased to see the headline figure of inflation falling, but, and this is a really important but, it is not a true reflection of demand pressures in the economy and demand pressures that drive inflation both up and down. That said, we've got this trimmed mean measure dropping from 3.8% down to 3.4%. So it's going in the right direction, and that's a welcome sort of change in momentum too. After we had that stubbornness, it was stuck in the high 3% range for the bulk of the first half of 2024. We're now down at 3.4, and just looking at the run rate, we're going to be in the threes, the low threes in the next couple of months. But from the RBA perspective, and it's open to debate, they're sort of going to be saying, well, look, we're pleased, but we're not quite compelled in terms of adjusting monetary policy on the back of this better news. They want to see several more months of confirmation that headline underlying inflation pressures are lower. And the other thing that's in their mix is, of course, what happens to unemployment.
Stephen, you've mentioned the power prices and the government rebates, both federal and state. The government wasn't involved in petrol prices, but they were changed in the last quarter or last month in particular. Do you think they've played a part as well, and how important is that?
Yeah, well, over the year they fell 7%. And just as I drive around, I always have a look at petrol prices because I'm always trying to get that leading edge on what's happening to inflation pressures. And petrol have a reasonably significant weighting, and they're a big, what do we call it, a sticker shock, that when prices are above $2 a litre, we think, oh my goodness, that's hurting my pay packet. When it's down at $1.70, oh, that's okay, And it does have follow-through implications on transport costs, logistics costs, when the truck drives into the supermarket full of items that we buy and sell. When the petrol price is higher, the transport companies pass it on too, and similarly with the airlines. So the fact that the oil prices come down is a really important part of the headline inflation reading. But again, as we've discussed on the way up and on the way down, the RBA could set interest rates at between 0, 10, 100%, and it'd have no effect on the price of oil around the world. It's a globally determined price.
Stay with me, Stephen. We'll be back in a minute. I'm speaking with Stephen Koukoulas, better known as the Kouk. Reserve Bank Governor Michelle Bullock, she has been direct. The Reserve Bank focuses on underlying inflation, and fresh off the back of the RBA board meeting and the media conferences you mentioned earlier this week, what do you think the RBA is making of these new CPI numbers?
Look, they'll be pleased. I think it's fair to say that they've been a little frustrated, like a lot of us have been, about how long it's taking inflation to come down. And even though it's the headline figure, and as we discussed, it's electricity subsidies, transport subsidies, these sorts of things that have driven that headline figure down. As she alluded to on Tuesday afternoon at her press conference, it is what do we call it? An inflation expectations driver too. If people can sort of see that inflation is below 3%, and the media last night was covering this inflation number with a great deal of gusto. And if people say, well, inflation's below 3%, my wages growth is 3.5% to 4%. For the first time in many years, to be honest, we've got this real wages just edging up a bit. I don't want to get too excited, but we've got this turning point. One thing that does excite me about economics is turning points. We've got a turning point after having years and years and years of real wages declining. We're in the early stages of this cost of living pressure easing. And we know what that means, Adam, because when cost of living pressure eases, we consumers breathe a sigh of relief, and we're a little more inclined to spend. And so some of this weakness in the economy is going to be, again, I don't want to be jumping the gun, but you can sort of see a scenario going through to the end of 2024, into the early months of 2025, that if inflation is 2 point something, wages growth is 3 point something, we're going to have slightly better economic news, and the consumer is going to be the one that drives slightly better news on the economy. As I said, I don't want to get too carried away, but I like what I see.
It's almost emotional, isn't it, Stephen?
It is. I wear my heart on my sleeve when it comes to the economy. And, I like economic growth. I like low inflation. I like job creation. I like the stock market hitting record highs. I like people to make money and do well.
Yeah.
And as I look through this run of news on the economy, I'm happier today than I was, a month ago, put it that way.
Yeah, well, I think we're all, as to your point, is looking for signs of relief that some of this might be getting better.
Yeah. And I think that's the critical issue. And the interest rate relief is still a little way away. I'd love them to cut interest rates tomorrow or the next month or whatever. It's probably a little bit too early to sort of genuinely talk about that, but it's on the agenda. I think it's moving on to the agenda. And, we saw again earlier this week the People's Bank of China cutting interest rates because the Chinese economy is under a lot of pressure. Last week, the Fed cut 50 basis points. There's all these central banks looking at their economies, not just Australia. And I think it's important for us sometimes to reflect on global economic conditions. But you don't get the Americans, the Chinese, the Europeans, the Brits, the Canadians, the New Zealanders, all cutting interest rates for fun. They don't do it for fun. In fact, on the contrary, they're sort of the tough central bankers of the world. They do it because they can see their inflation rates falling in their own economies. They can see weaker growth and they can see higher unemployment. They're the sort of fundamentals that are starting to sort of creep into the Australian psyche a little bit more. And again, as we're going back to yesterday's inflation number, we've got the inflation rate coming back towards target. We'd like it to be there for a few more months, but hey, we're almost there, as the father says to the kids as they're driving to that coast holiday. We there yet? Well, we're almost there. Hang on, we're almost there. Just got to get around this corner and down the hill and into the motel.
Now, Stephen, as you mentioned, there's often a lot of science and a bit of art at play here. Most data is from the past, and we do have some precious forward indicators, but there's no perfect view of the path ahead. We know that growth has slowed. Do you think there's an argument that the RBA is being too conservative? Are we at risk of recession here?
Yeah, look, to be fair, I think they have been a little bit too cautious. I know that they don't like to adjust interest rates until they have to. I'm more of the view that they've got this blunt instrument, interest rates, use it a bit more frequently. And as I've been saying to a few other people just in this last week or so, what would happen if, for argument's sake, they cut interest rates earlier this week and they cut them again before Christmas? What would happen to the inflation outlook? Would it really kickstart a surge in inflation? Well, probably not, given how weak the economy currently is. Would it be that little bit of insurance against a weaker economy in 2025? Yeah, it would. It would generate that bit of a move to optimism, if we can say, on the consumer side of the economy. So, again, the Reserve Bank can always catch up. And as we saw in the Fed just last week, when they maybe should have cut 25 a month ago, they went 50. Now, I'm not saying that the RBA will go 50, but if we get to, say, December, unemployment's 4.5 or above, and we get another low CPI, they can go 50 if they find that they're a little bit behind the curve.
Stephen, you've mentioned the labour market as well. It's proven itself to be quite resilient. Let's talk about house prices a little bit. There's always a mix of supply and demand factors at play with housing, but how do you see the RBA's impact on the demand side for property?
Yeah, look, the interest rates going up obviously does restrict the amount of money you can borrow. All the lenders do in their mortgage calculator, look at your income, look at your borrowing capacity against a specific interest rate plus a margin for APRA and other requirements in case interest rates unexpectedly go up. And so as interest rates go up, your borrowing capacity is trimmed. That said, the banks have as their biggest driver of lending your labour force status, and that's economic jargon for whether you've got a job or not. If you don't have a job and interest rates are 0%, they're not going to lend you a cracker. It has nothing to do with the interest rate settings. If you have a secure job with an okay income and you maintain your employment, even with interest rates being higher, the banks are more inclined to lend. And I think that explains why in the last, 18 months or so, with the interest rate hikes that we've seen, house prices have generally tended to go up. There's a big difference between, say, Melbourne and Hobart and Perth and Brisbane booming, Melbourne, Hobart in the doldrums. But at an aggregate level, the banks are more inclined to be driven by what's happening to your job status as opposed to interest rates. And I think that's a critical thing. So for the house price cycle getting towards the end of this year and into 2025, I think the bigger thing, rather than interest rate cuts maybe fueling a bit of demand for housing, yes, that will happen, of course it will, is whether we get unemployment increasing too much and the banks are saying, look, I'm not going to lend too much money to people at risk of becoming unemployed because I might not get my money back.
That makes complete sense. Stephen, that is great perspective. Thank you so much for talking to Fear and Greed.
Thanks, Adam. All the best.
That was Stephen Koukoulas, better known as The Kouk, and you can find him at thekouk.com and follow him on X using the handle The Kouk. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed. It's daily business news for people who make their own decisions. I'm Adam Lang. Enjoy your day.